Welcome! Have you ever wondered how great companies really work? Not just the stuff they sell, but the financial engine humming away under the hood? Well, today we're going to pop that hood wide open. We're talking about corporate finance, basically giving you the toolkit you need to speak the language of business. So let's kick things off with the biggest question of all. Really think about it. It all boils down to this single question. Imagine a company is this incredible, powerful machine. It could have the most brilliant design in the world, but without fuel, it's just a beautiful sculpture that doesn't go anywhere. And in the world of business, that fuel is called capital. It's the money that gets the machine started, keeps it running, and helps it grow. So our first stop on this journey is figuring out, where does this fuel even come from? A company needs money to get going, and it's got two main gas stations it can pull into. All right, so these are the two big ones, equity and debt. With equity, the company literally sells off a piece of itself, a slice of the ownership pie. It does this by creating things called shares. Investors buy them, and bam, they become part owners. Then there's debt. This is much simpler. The company just borrows money and promises to pay it back, plus interest. The key difference? The person lending the money never, ever becomes an owner. It's that classic fork in the road. Do you sell a part of your creation, or do you just take out a loan? Now, for the rest of this explainer, we're going to zero in on equity. Honestly, it's such a fascinating idea. This concept of turning a business into tangible, sellable pieces of ownership, like handing out the keys to the machine. So, how exactly does a company go about selling these slices? Well, like we said, it issues shares. And you can just think of a share as a single unit of ownership in that corporate machine. But here's the thing, not all shares are created equal. First up, you've got ordinary shares. These are by far the most common type. If you own one of these, you are a true blue owner. You get a say in how the company is run through voting rights, and you get a cut of the profits, which are called dividends. But here's the catch. Those dividends can swing wildly up or down depending on how the company's doing. You're taking on the biggest risk, but you're also in line for the biggest potential rewards and the most control. And then you have preference shares. Think of these as a kind of VIP ticket. People who hold these get their dividends paid out before the ordinary shareholders. Plus, that dividend is usually a fixed, predictable amount. So what's the trade-off? Well, they almost never get any voting rights. So it's kind of a hybrid. It's got the steady payment of a loan, but at the end of the day, it's still a piece of ownership. Okay, so a company decides to issue shares to raise some cash. But how does it actually decide on a price? It's not just some random number they pull out of a hat. And understanding this is where you really start to see what a company's value is all about. Now, this slide breaks it down perfectly. Let's look at this example. A company, ON plc, issues a share for 120 naira, but that price actually has two separate parts. First, there's the nominal value, which is only 20 naira. You can think of this as the official, legal, bare-bones minimum price. But investors are willing to pay way more than that. They're paying 120. That extra 100 naira is called the share premium. It's the brand bonus, it's the hype, it's what people think the company is really worth based on its future potential. So the company gets the full 120 naira in cash, but it has to record that money in two different pots for accounting purposes. And that share premium pot of money, it's incredibly important. It's not profit the company can just go spend on anything. It's a special reserve of capital that can only be used for very specific things. Like, for example, issuing bonus shares to its existing owners. And that leads us perfectly into our next topic. So once a company has its shareholders and these special capital reserves, it can start doing some pretty interesting things, either to reward those owners or to raise even more money without going out to the general public again. This brings us to something called a bonus issue. This is when a company just gives its current shareholders new shares, completely for free. Now, it's not magic money. What the company is actually doing is taking the cash sitting in its reserves, like that share premium account we just talked about, and turning it into new shares. It's often seen as a sign of confidence from management about the company's future. And this shows you exactly how it works step by step. The company has that pot of reserves. It decides to capitalize them, which is just a fancy way of saying it turns that cash into actual shares. Then it just hands them out to its shareholders based on how many shares they already own. So if you own, say, 1% of the company, you get 1% of the new bonus shares. The pie is now cut into more slices, but you still own the exact same percentage of the whole pie. But what if the company needs to raise brand new cash? Well, it can make a special offer just for its current owners. This is called a rights issue. It's kind of like an exclusive early bird sale. The company gives its shareholders the right to buy new shares, usually at a pretty sweet discount, before anybody else in the world gets a chance. So why would a company do this? Well, for one, it's a super efficient way to get more fuel for the engine. It's way cheaper and faster than doing a massive public offering. But maybe more importantly, it's a way of showing respect to the people who already own a piece of the company, giving them the first shot to buy more so their ownership stake doesn't get watered down. Okay, so the company has its fuel. The machine is up and running, and it's making things happen. But how does it report back to its owners? I mean, how did they know if their investment is actually being put to good use? Well, every year, they get a report card. And this report card comes in the form of what are called financial statements. These are legally required, totally standardized documents that tell the complete story of a company's health and performance, all in the universal language of numbers. A full report card actually has several parts, as you can see right here. Each one tells a slightly different part of the story. But, to really get the main plot, you can start by just mastering the two big ones, the statement of financial position and the statement of profit or loss. They give you the clearest picture, by far. Because at the end of the day, that's what these documents really are. They're a story. And if you know how to read them, you can understand exactly what's happening inside that corporate machine. First up, we have the statement of financial position. The absolute best way to think about this is like a snapshot. It's a photo of the company on one specific day. On one side, you have everything the company owns. Those are its assets. On the other side, everything it owes to other people. Those are its liabilities, and whatever's left over when you subtract what it owes from what it owns, that's the equity. That's the part that truly 100% belongs to the owners. Now, if the first statement was a snapshot, then the statement of profit or loss is more like a video. It shows you the company's performance over a period of time, like a quarter or a whole year. It starts at the top with all the money that came in the door. That's revenue. Then it subtracts all the costs of doing business. Those are the expenses. And that final number, the bottom line, tells you whether the company made a profit or took a loss. It's where the rubber meets the road. So, here's the crucial takeaway. When you put these statements together, you don't just get a bunch of numbers. You get a real narrative. You see the capital being raised at the beginning, you see how that fuel is being used to run the machine, and you find out if that machine is actually creating value for its owners. It ties our entire story together, from start to finish. From a single share being sold to a single line item on a financial report, every number tells a piece of a company's story. And now, you basically have the decoder ring. You know how to start reading that story. So the only question left is, what stories are you going to uncover?